If you ever looked at commercial real estate and thought, I like the returns, but I don't want to manage tenants, toilets, or operations, this video is for you. I'm Jeff Roma with CAE Self Storage. Today I'm going to break down clearly and simply how limited partners or LPs actually make money investing in self storage or really any commercial real estate. No hype, no fluff, just math and risk management and structure. If you're a business owner, a high income professional, or somebody looking to diversify outside the stock market, this will give you clarity. Let's begin with the basics. In a self-storage syndication or any syndication, there are two roles: the general partner or the GP and the limited partner or the LP. Now, the general partner finds the deal, secures the financing, executes the business plan, manages the property, handles reporting, and puts together the team. They might be putting a team together on the general partner side. Now, the limited partner invests capital, owns equity, receives distributions, has limited liability, and does not manage any operations. You are passive. You're not signing personally on the debt. You're not answering tenant calls. You are investing alongside a professional operating team. Now let's talk about how LPs actually earn returns. There are typically three ways. First, a preferred return. Most structured deals offer a preferred return. Now, what's a preferred return? Often it's 6 to 8%, and sometimes up to 12 depending on the deal. That means the LP gets paid first before the operator participates in the profit. So you can think about it as keeping your money in a bank that's paying you some interest for holding that money. Now, if the property generates cash flow, LPs receive that preferred return before performance splits kick in. That creates alignment, and the operator only benefits after investors are paid. Now, second, cash flow. Distributions. After the preferred return is met, additional profits are split. Say 70% to the LPs, 30% to the GPs. There's some sort of split depending on the deal. Self-storage tends to have stronger margins than multifamily. Why? You're not painting or replacing carpets every year or every time somebody moves out. There's no plumbing in the units. There's minimal staffing, low maintenance for sure. Month-to-month leases are also very important. When we improve occupancy or increase rents or reduce expenses, cash flow improves and LPs participate in that upside. Third, appreciation. This is where significant wealth is often created. Commercial real estate is valued based on what's called net operating income. So increase the NOI and you increase value. For example, if a property generates $500,000 in NOI each year at a 6.5 cap rate, that's roughly $7 to $8 million. It's real simple to figure that out, by the way. Take the NOI and divide it by the cap rate. If the NOI increases to say 600,000, value jumps immediately. And that value increase just on $100,000 is roughly about $1.5 million in value. And that flows directly to the equity holders, including the LPs. This is the power of disciplined value add execution. Now, what I like about self-storage specifically is self-storage is operationally lean. It's historically recession resilient. Demand is driven by life events, right? So moving, divorce, downsizing, business inventory, relocation. These events happen in strong economies and weak ones. Compared to multifamily, there's typically lower payroll, lower regulation, lower tenant risk, lower expense ratios. From a risk-adjusted perspective, storage can be extremely compelling when underwritten conservatively. Now let's talk about risk. Every investment has risk. The key is risk management. Disciplined operators focus on market first analysis. I can't stress this enough. Supply per capita thresholds, very important. And we want conservative rent growth. Stress testing any downside scenario that might come up. Thoughtful debt structure, also very important. And exit cap rate expansion modeling. LPs should always ask, what happens if our occupancy drops? What happens if interest rates rise? What if lease up takes longer than expected? Professionals plan for these before capital is ever raised. That's how capital is protected. A good operator will mitigate risk before the deal is really even closed. So if you're considering becoming an LP, look for 5 things. The first one, pretty important, operator track record. Second, conservative underwriting. Also, transparent reporting, alignment of incentives, and really a clear exit strategy. Avoid overly aggressive projections, avoid fantasy rent growth, avoid deals built on perfect conditions. This is about disciplined wealth building, not just some speculation. Limited partnerships allow you to participate in commercial real estate ownership without managing properties, without signing on debt, without building an operations team yourself. When structured properly and executed with discipline, self-storage can offer cash flow, equity growth, diversification, tax advantages, and long-term capital preservation. If you'd like a deeper breakdown on how we structure deals and evaluate markets, comment storage and I'll send you a private training. I appreciate you taking the time to watch and I look forward to helping you make informed investment decisions.